Now we'll look at the different methods of project evaluation. This is just an introduction, or you can say an glimpse into what techniques you're going to study with the different project evaluations. And then we're going to go and study each and every method in depth along with a good example for it. So there are 6 different methods of project evaluation which you're going to study. The first is the net present value method. Over here, you try to determine what is the net present value expected to come out of if the project is undertaken. Okay. The next is internal rate of return, IRR. This is more of a trial and error mathematical method where you happen to determine the break-even point in terms of percentage of return. Whereas you try to determine that percentage of return where you have a break-even point, that is all your investment and your inflows equal up to zero, no profit or no loss situation. Next is a payback period method. In this method, we're trying to define how quickly can the project recover the entire cost invested in that. Next is a discounted cash flow analysis. This method is said to be an extension of the payback period method, but over here you try to discount the cash flow based on the future value of the cash flow and then determine what is the earliest point of time when you can have the actual recovery in terms of the present value of cash. Now, need not be concerned if you're not aware of the present value figures and future value computations. In the next session, first we're going to study the present value concept and then we're going to go in depth with all of these methods. The fifth method is the opportunity cost analysis. Now, this is not exactly a project evaluation method, but it's a good concept for you to be aware of how do you define the incremental cost, the opportunity lost when you take up the other project, and what is the incremental gain by taking up the opportunity or the existing project which you are carrying right now. And the last is earned value analysis. Now, the sixth method, earned value analysis, is not a method which you take into hand for deciding which project to take on. This method is applied once a project has started, once you have decided which project to pursue and you have started working on that project. Okay. Now, if you're going to start with the sixth method, obviously, I believe you will have a question in mind which project evaluation method is to be selected. Now, understand this thing that every project evaluation technique serves a different purpose, and therefore it is important to select the project evaluation method, or you can say the method for the evaluation according to the needs of the organization, according to the intention for taking up that particular project. Let's say if the company wants to recover the money on a earliest basis, that is a priority for the project to be selected, right? That's a criteria. In that case, you select the payback period method. However, if profit is the priority, profit percentage earned is the priority, then you go for the internal rate of return method. Okay. If positive cash flow at the end of the project completion is important, then you go for the net present value method. So you can understand that every project evaluation method has a different intention, a different purpose to be served, and you need to identify what is the intention of taking up the project, and then it's better to, and then you have a proper judgment as to the method which you're selecting is a correct method or not. Okay. With this thing in mind, we'll go to the next session and start studying each and every method in detail. Now, before we begin with each and every individual method of project evaluation techniques, it's important for us to understand the concept of present value. What does the present value mean? Present value is the sum, or you can say the current value of sum of money or stream of cash flows at a specified rate of return which are supposed to be received in the future. Okay, so it means that it is, to simply put in a layman's terms, it can be said that receiving $10,000 now is worth more than receiving the $10,000 5 years from now. Now, why does this happen? If you recollect the fact, we had an concept of inflation, right? Every year, the inflation rates are going high and high and high. So it's obvious that the purchasing power of $10,000 today, as on date, will not be the same as of 5 years from now. If you can get a brand new 4K TV for $10,000 today, 5 years from now, it's highly possible that the cost of that same TV will be around 15,000. You can say 12 to 15,000 at least. It will be increased, but it won't go beyond 10,000. That's why it's important to know this thing. How do you compute what is the present value of my money which I'm going to receive in the future? Because if you understand the very fact, all the projects in that you're going to invest the money right up front, right? But they're going to take a good amount of time, might be 3 years, 5 years, 10 years down the line to give out a constant return. But that return which you expect to receive 10 years from now, which can be $10,000 a year, it's not going to be the same, it's not going to have the same purchasing power as a $10,000 today, right? So it's important to bring down the future 10,000 value to its present value, bring down the value. Always remember this thing. that when you're going to be trying to determine the present value of your future receipts, it's always going to be lower than what you're going to receive in the future. So let's say if you're going to receive $10,000 in the future from 5 years from now, its value as on today will definitely be less than 10,000, because it's going to appreciate to that amount to receive to go to a level of $10,000. Okay, so that's why it's important to know the concept of present value to get a much more understanding, or you can say much to make much more informed decision in any of your project selections. Let us see the formula for present value, or you can say how the computation of present value works. The formula is C1 divided by 1 plus R raised to the power of n. Now your PV is your present value. C1 is a future value of the cash to be received. Like say, you know that 5 years from now, the project is going to give you $10,000. So that's the future value of the cash to be received. The future value is 10,000. We're going to try to discount that and bring it down to current value. The R is a discount rate. Now this is basically the interest rate at which, or you can say the income rate, discounted rate, which you got expect to receive over the number of years. So every company has their own hurdle rates, which is the discount rate over here. We're going to talk about this in detail as and how we go about. But understand this thing: if a company expects that its resources generate a 7% risk-free return, so that is a discount rate over here. What is the amount of interest, or you can say the interest risk-free investment return the company expects to generate? It can also be a higher one. It's not necessary that always the company should have a risk-free one. If the company states that always all the investments done by them till date have been generating a return of 15 to 20%, so even that can be discount rate. Nothing is bounded over. It's all supposed to be defined. So as a project manager, it's really important for you to determine what is a company's discount rate at first. Then only you can make an informed decision for arriving at the present value concept. Okay. Next is the N. That is 1 plus R raised to the power of N. That is a number of periods. Now this number of periods can be a yearly, a 6 monthly, a quarterly thing, anything. Okay. With this thing in mind, let us see a quick example. Ideally, let us prepare a quick example to understand the concept of present value. So we have Excel ready over here. Now let's say we need to compute the present value of $100,000 expected to receive after 3 years, discounted at 10%. Okay, so I'll just note it down over here. Compute the present value of $100,000 expected to be received after 3 years, discounted at 10%. Fine. Now, before you go ahead in depth of this, let's try to interpret the formula which we had used over here. That is the cash future value of the cash receipts divided by the 1 plus rate of return or discount rate raised to the power of n. So over here, if we had to replace C1 will be $100,000. That is the future present value of the future cash flow to be received. The discount rate will be 10%, and the period will be annual periods. That is going to be 3 years. So replacing this in the formula, we have $100,000 divided by 1 plus 0.1 raised to the power of 3. Okay, right. Now, if we were supposed to do 1 plus 1, we'll just try to understand this mathematically. We also have an entire table, ready table available with us, but I'll show you how to read the table. But to read the table, it's important for you to know how the formula, multiplications, and factors are working up here. So, coming back to our example, we can say it's 1 plus 1.1 multiplied by 1.1 multiplied by 1.1. That's 1.1 raised to the power of 3, right? Now, if I was supposed to actually see the amount, it's going to be 1.331. So, putting the figures over here, it's going to be $100,000 divided by 1.331 equal to 100,000 divided by 1.331. The present value is supposed to be $75,131.48. So, to put it in a layman terms, $75,131 today will be valued at $100,000 3 years from now, discounted at 10% rate. So that is how you compute the present value of the future cash flows, or the future amount of money to be received. Now, I just put the equal to sign so you understand how the steps are derived. Now we'll just we did this thing with the entirely our own computation, right? We used the formula, actually multiplied 1.1 into 1.1 into 1.1. Suppose you had a period of, say, something around 15 years. At that point of time, it will be really chaotic to multiply and determine these values, right? So that's why we already have a present value table along with us. Now, this table is a standardized one. Over here, you have two categories, present value and future value. We're going to focus our efforts, or you can say we're going to focus on this part of the table, present value. Not to leave you guys in suspense, I'll just give a short insight what is present value and what is future value. Present value we already covered. We're trying to determine the future value of the amount which is supposed to be received in future as on today. Like in this example over here, the $100,000 that we're going to receive 3 years from now, today its present value is $75,131. In the same way, the present future value works in a reverse order. So you know the fact that you have $75,131 in hand today. What will be is future value based on a 10% discount rate, 10% earning rate in the next 3 years. It goes the reverse way. And you also can say that the future value of $75,131 today will be $100,000 3 years from now, discounted at a 10% rate. That is an earning of 10% income on this $75,131. So it's a reverse order. On one case, you know the future value and you try to bring it down to its present value. In other case, you know the present value of the money and you're trying to determine what will be its value, appreciated value in the future, because money is always appreciating unless the economy is facing a deflation. Like you can say the value of money is going down. Okay, so getting back to a table, how do you study the table over here? So remember this thing, we had a discount rate of 10%, that is a hurdle rate of interest is 10%. So we're going to look at over here 10%. Now 10% for 3 years. So you have this over here, number of year period 0.9091, 0.8246 and 0.7513. We need the amount, you can say we need the value at the end of third year. So that is the number over here, 7513. So what this means is that $1 today discounted at 10%, after 3 years its value is going to be 0.7513. Now if we replace this 0.7513 in our equation over here, multiply this value by $100,000, you have $75,130 over here. The difference is due to the rounding of the amount, but it's approximately the same amount, right? 75,131 and 75,130. That is a difference of $1.48 only. So this is how you study the present value tables. Okay, I just mentioned over here present value using present value table. I'll give a short note. Referring 10% column, that is this amount over here, referring the 10% column, discount column for the third year, that's gonna be the present value is 0.7513. Therefore the present value of $100,000 is $75,130. I hope you got the gist, or you got a brief summary of how do you compute the present value, what's it used, why is it required in your project evaluation techniques, and now we're going to study each and every method in depth. But again, I request you guys to go through this one more time to understand thoroughly the concept of present value. Without it, most of the future, or you can say most of the evaluation techniques which you're going to study are not going to be helpful much to you then. With this thing in mind, we complete the concept of present value and we move on now actually to studying the 6 different methods of project evaluation. Now we begin with our project evaluation techniques, and we begin with the first method, that is net present value. So let us understand what is the concept of net present value first of all, before we jump into the depth of all the jingles and understanding evaluation of the results and so on. So the net present value is the present value of the project's expected future cash flow minus the project's initial cash outflow. So you can say that the net present value is the final result of the project's future expected cash flow minus its initial cash outflow. Now, projects, or you can say the present value of the expected future cash flow. This is calculated by using the discount rate, that is the company's required rate of return. So if you remember from the concept of present value, how we had used the discount rate to determine the present value of the money which is supposed to be received in future. That's exactly the same concept which is going to apply over here. That's why it's important for you to understand what is the concept of present value of money. Okay, coming back to the net present value, the present value of the expected future cash flow, the one which we're going to interpret, which are going to come in the future, is discounted using the company's required rate of return. So every company has their own benchmark, right? Before evaluating any project, obviously there's always a risk-free investment option available for any entity, any person. But because businesses are uncertain and take a risk, they expect the projects to reward them with a higher rate of return, so either higher income. So every company has defined their own required rate of return, which is based on multiple factors which they take into account and arrive at a final computed figure. Over here, we need to understand that this required rate of return is going to serve as a discount rate for you. That is, the company is going to evaluate the future value or present value of money using their own required rate of return as a discount rate when you compute the net present value. Now, this required rate of return is either the return the organization could expect to receive in the market from an investment of a comparable risk. Let's say your project has a 50-50 chances of failure and a success, and also there is an alternative in the market which has a similar 50-50 chance of pass or failure, of success or unsuccessful. If that project is giving the rate or required rate of return, or you can say that project is generating an income of 15%, then obviously you can use that same benchmark to determine the discount rate for your project. Or else, that can be the minimum rate of return that the project must earn in order to justify investment of the resources. Many times it happens that the companies themselves have developed an internal required rate of return, and they have this thing that if you want your project to be qualified, if you want the company to fund your project, you need to prove them that your project is generating at least required rate of return expected by the company. So as a project manager, you really don't need to go into the depth of this entire stuff. You can have this numbers, required rate of returns, everything from the financial teams, but it's good to know how these numbers are arrived at, so you can tweak your projects accordingly to reach that level. You can justify your projects accordingly to reach to that level and get the funding from the company. Now, the required rate of return is also called as a discount rate, hurdle rate, opportunity cost of capital, and such other names. Generally, company's cost of capital is used as a discount rate. Now, the company's cost of capital is entirely a big topic in itself, okay? But to give you a glimpse of that, what happens is that companies raise their funding by various sources. They can be loans, bonds, debt, share capital, preference capital, and such a thing. And every capital raised, every financing arrangement has their own required, or you can say has their own payout things. For example, bonds have a fixed interest payment year on year and upon maturity. Debt has similarly a fixed interest rate. So these are the required cost of capital the company needs to pay. Equity shareholders of the company, depending on the risk appetite or this risk level of the company, have either a higher expected return or a lower expected return. Preference shareholders have a preference share dividend expected returns, and sometimes if it's going to be converted to equity and all, there's a different game. But when all these interest factors are taken into account, the company arrives at one single cost of capital, that is a weighted average cost of capital, which is proportion. The weights are depending on the amount of funding raised from various sources, and that final figure is known as the cost of capital for the company. Now again, this is entirely a topic of records. You really don't need to understand this in depth. You will be given your cost of capital or the discount rate and just need to use those amounts into your computation to arrive at the final net present value. But as I said, a bit more knowledge is not harmful, and it goes a long way to help you to understand and stand out as a project manager. Okay, so coming back to the question in hand, now I believe you understood what is the concept of net present value theoretically. We're going to solve this sum practically also, but theoretically, I hope your concepts are clear. Now, how do you evaluate the net present value? When you have the results in front of you, how do you evaluate that? So, when a project has a positive net present value, that is all the present value of the future cash inflows minus the cash outflow, still generates a positive number. That means the project will be profitable because it will earn more than it will cost the company. So it will increase the wealth of the shareholders ultimately, and the company should accept the project. If the project has a negative present value, that is, their present value of the cash inflow is less than the total of the cash outflows, it is it is an unprofitable project for the company, because this will cost the company more than it will earn for the company. Hence, it's better to reject it. And lastly, if the project has a zero net present value, that is, here the project is neither profitable nor in a loss state. If you're going to invest, supposedly say $100,000 in the project, the present value of all the cash inflows which it's going to generate is exactly $100,000 only. And this is not the acceptance of this project or the rejection of this project is neither going to impact the shareholders' wealth in any case. It will neither increase the shareholders' wealth nor the profits of the company, neither it will decrease the profit of the company or the shareholders' wealth ultimate. So in a way, the company is indifferent financially, saying from the financial standpoint, if the company accepts the project with a zero present value. So this was all with regard to the concept of present value. Now we're going to look at an example which we're going to create and solve together. So that will give us a better understanding of the net present value. So let's go to our Excel sheets and start preparing the example. Okay, so let us say ABC company needs to decide whether to accept a project based on NPV. The company's discount rate is 6%. The relative cash flow details are as under. You have your cash outflow, or you can also say it as an investment for the project in year one itself for let's say $501,000. Oops. You have the cash inflow over 8 years as follow. We'll try to take a different approach. We'll not just say that the project is going to earn a constant cash flow. We'll say the cash flow amounts are going to change across some years. So for the year 1 to 4, let's say the cash inflow will be $77,000 for year 1 to 4. For year 5 to 7, we'll put it as $85,000. And lastly, in the year 8, the last year, you have a high increase in the cash flow, and we'll bring it to 1,01,800 something. Yeah, just random figures right now. Okay, now we're going to compute the project's net present value. So first of all, it's important to know what is the company's discount rate. The discount rate is 6%, which is the company's required rate of return. So we're going to need a couple of columns over here. Let's say the period. Over here we have the net cash flow. We're going to put the 6% present value factor from the present value table. I'll just mention here, derived from present value table. If you remember, we had seen the present value table the previous session where we are understanding the concept of present value. That whole table, I'm going to attach a table to you guys for your reference. You can use that table to understand, or you can say for easy computations. And finally, you get the discounted cash flow amount. Okay, discount cash flow at 6%. At 6%. Whew. So here you have 1, year 1, 2, 3, 4, 5, 6, 7, 8. Year 2, year 3, year 4, year 5, year 6, year 7, and finally year 8. Net cash flows. In the initial year, the company is going to have a net cash flow of $501,000. That's a negative figure over here. We'll just set it to the numbers over here. Okay, this needs to be in the number format. In the next year, from year 1 to year 4, the company is going to have the first cash flow starts from year 2. Year 1, obviously there's a cash outflow and it does not start earning from year 1. From next year onwards, it's going to have a net cash inflow of $77,000 up till year 4. $85,000 from year 5 to year 7. And lastly, it's $1,01,800. Now we'll pick up these values from the present value table. So we have the present value table over here. Okay, here we have the future value. We're going to look for the present value computations. And here we have the present value interest factors for $1 discounted at X per K percent for N periods, so and so. Okay, 6% over here we have it. For the first year, no. Are we going to look at that? Oh, 1 second, guys. I just need to rectify something. Okay, this is what I was thinking. It's wrong. Initial investment is going to be coming over here, and this is going to be $77,000. And this remains the same from year 1 to year 4 because this inflow is going to arrive to us at the end of the year 1, and obviously $1 at Jan 1st will not have the same purchasing power as on December 31st. So here we're going to go with the same previous assumption that the inflow starts from year 1. So that will help us to reconcile this with the present value table over here, or else it might be just confusing that why did we start from year 2 and not from year 1. Okay, so 6% present value factor for the initial investment, it's going to be entirely the same. $1 is the value is $1 on the same day itself, but $1 at 6% at the end of year 1, it's 0.9434. I think I need to increase the zeros decimal, right? For the next year, it's going to be 8,900. So it's 0.8900. Okay, that's four decimals over here. For the third year, it's going to be 0.8396. 0.8396. For the fourth year, it's going to be 0.7921. 0.7921. For the fifth year, it's going to be 0.7473. 0.7473. For the sixth year, the value of $1 is going to be 0.7050. 0.7050. Seventh year, it's going to be 6651. 0.6651. 0.6274 for the last year. 0.6274 for the last year. Perfect. Now it's simple. We're just going to multiply the net cash flow with the present value factor, and that goes for the same. The same formula applies for everyone. And you have the dollar values over here, right? So let's round this off to 0 over here. Okay, perfect. Now, if we put this in accounting format, we'll have the currency figure over here, right? So now the net present value is your sum of the total outflow minus total inflows present value minus the cash outflow. If you remember from the definition, net present value is the present value of the projected future cash inflow. This is the amount of the projected future cash inflow, that is 5,10,661 against an investment of 5,01,501,000. So here you have a net present value, a positive net present value of $9,661. Therefore, the project should be accepted. I just mentioned note here, since the net present value is greater than zero, the project is profitable, hence should be accepted. So this is how you interpret the entire cash net present value of the project. So here, now let us try to figure out what would have happened if you had taken the discount rate at 8%, just so to get one more tweak in the whole scenario. We'll use the same formulas over here. The only difference is going to be in terms of we'll write here, assume that the discount rate is, we'll just double it up, 12%. So we have this over here at 12%, discounted cash flow at 12%. That's all. These numbers are going to change, rest all things remain the same. So if you see this thing over here, we have the 12% discount rate over here, and the initial investment is always going to be remaining the one, because you're going to invest the amount today itself. If it's going to be invested in the future, then obviously those amounts need to be brought to the present value, but we'll avoid that high-end competition as of now. We'll just stick to the basics right now. Let's change the present value factors over here to 12% from 6%. So For the first year, it's going to be 0.8929. 0.8929. For the next year, it's going to be 0.7972. 0.7972. Notice this thing, because it's a formula based thing, then the moment you enter the present value, revised present value over here, all the computation take care of itself. For the third year, it's going to be 0.7118. 0.7118. For the fourth year, it's going to be 0.6355. 0.6355. Fifth year, it's going to be 5674. 74. Sixth year, it's going to be 5066. 0.5066. Seventh, it's going to be 4523. 0.4523. Lastly, eighth year, it's going to be 0.4039. 4039. Oh, the results change drastically. Now, if the company accepts this project, it will end up in the negative net present value of $96,268. That means against an investment of $501,000, the company is going to have a loss of $96,268. So over here, the conclusion is that since NPV is less than 0, it's supposed the project is not supposed to be taken ahead, to be taken up. Okay. I did not plan for this discount rate of 12%. I just thought we'll just see how the results come up when you use a different discount rates. So that was all, guys, with regard to the net present value. And I hope this was sufficient and clear enough for you guys to interpret and make your own net present value computations. I'll see you in the next session. We're going to start with the another method of project evaluation. Now we come to the next method of project evaluation, that is internal rate of return. So internal rate of return, what is this internal rate of return method? So in the internal rate of return method, or you can say the internal rate of return is that interest rate at which the net present value of all the cash flows, both positive and negative from a project or investment, equals to 0. I understand the definition was on a quite higher level. Let's try to simplify it down. So in the net present value, you try to arrive at a number, okay, a dollar value, and then you evaluate, is the dollar value greater than 0 or less than 0, okay? That dollar value was arrived at using the discount rate, presenting it to the current value, and such stuff like that. In the internal rate of return, you take a different approach. Although your intentions are the same to determine whether the project is acceptable or not. But over here, you try to figure out that discount rate or that rate of return where which makes your net present value equal to 0. That means you neither in a positive state, neither in a negative state. And then based on that rate of return, you determine whether you should accept the project or not by comparing it with the existing company's required rate of return. So to simplify it down, okay, before that, this method has to be done by a mathematical trial and error basis. There's no such definition where you can just use one single rate and assume that to a discount rate and carry on computations. No. So what happens in this method is that you know what is your present cash outflow, you know what is the future cash inflows. Now, all the future cash inflows, you try to discount it by that factor through which the net present value, that is the sum of your initial outflow minus your future present value of your future inflows, becomes 0, and that becomes that discount rate at which these amounts become 0, that amount becomes your internal rate of return. Okay, so internal rate of return, I know it sounds a bit complicated right now, but once we have done the example, trust me, it's going to be crystal clear. The internal rate of return is used to evaluate the attractiveness of a project or an investment, because here you try to determine that interest rate, or you can say that discount rate, that profit rate, which is going to break even, at which point the company breaks even the earliest, and then you compare that with the company's required rate of return. If that is greater than the company's required rate of return, it's great, go ahead. If the IRR is greater than required rate of return, the project is desirable. The reverse goes when the IRR is less than the required rate of return, project should be rejected. The IRR must be, internal rate of return must be found by using mathematical trial and error to derive the appropriate rate. Understand the word, the appropriate rate. There's no fixed rate over here. You cannot arrive at one single rate. It's always going to be in closest range. Okay, it's very rare that the net present value will turn out to be 0, because sometimes you need to have a middle rate of return. Like, it cannot always be 16 or 70%. Sometimes it can be 16.67%, 16.25%, stuff like that. Because of which you try to come closest to the $0 value. So let's look at an example for this thing, and then I'm pretty sure this is going to be crystal clear to you guys. So coming at an example for this, where's my example sheet? We'll name this as IR computation, internal rate of return. Okay, so let's find the internal rate of return for an investment having an initial cash outflow of let's say $212,000. Okay, then we have the cash out inflows during first, second, third, fourth year, first to fourth year, as mentioned below, right? For the first year, it's supposed to be 65,000 approximately, $65,000. For the second year, it would be somewhere around let's say $96,000. 96,000. For the third year, we'll put it somewhere around $73,000. Fourth year, it's gonna be $55,500. Now I have already derived the net present value computation for these on various interest rates, and I've used the same formula, same template over here. Okay, so let us say, I mean, I do know the answers. I'm just trying to explain to you what the psychology was in approaching to the solution. First, we'll assume, so the first internal rate of return which you're going to try to determine is always going to be a random figure, an abstract number value. Okay, based on that you determine, okay, is it closer to zero, should I, or is it actually negative, should I increase my discount rate or should I reduce my discount rate? How does that work? We'll see in a couple of minutes. Assume that the R, or you can say the discount rate, is 10%. Okay, I'll just show you how the 10% discount rate works over here. We'll use the same template for time being. Just hold on a minute, guys. We're just done with the formatting ASAP, and we'll quickly jump to the solution. Okay, so the initial outflow is 212,000, right? So it's going to be 212,000, and now we're going to use the discount rate at 10%, discount get cash flow at 10%. We just need this amount here, from the present value tables. Where is my present value here? Okay, for 10% for the first year, it's 0.9091. So this is going to be 0.9091. For the second year, it's 0.8264. So it's going to be 0.8264. Third year, it's going to be 7513, 0.7513. For the last year, it's fourth year, it's going to be 0.6830, 0.6830, right? So here you have the net present value coming up to present value. As you can see, this is far beyond zero. Okay, that means that the 10% hurdle rate which we have taken is very less. We need to increase our discount rate factor to reduce the discounted cash flow. The logic behind is that the higher your discount rate, the higher your expected rate of return, your present value of that future cash flow starts reducing. Okay, so $1 discounted, or you can say $1 discounted at 10% today will be something, for first year will be 90 cents precisely. But the same thing, when $1 discounted at 15%, it becomes 0.896. So that's the logic, as in how if you want to reduce your present value and bring it down to zero, you need to increase the discount rate. With the same logic, now at various discount rates, at a discount rate of 13%, we just try to evaluate the whole thing rather than just putting up abstract values, right? So now we'll take it at a discount rate of 13%. We'll use the same template in entirety over here and just change this amounts to 13% over here. I mean, if you observe this one thing, if you have the Excel templates of the formulas, it becomes quite easy to change the figures and quickly, guess the answers. And you, in fact, have the internal rate of returns templates of Excel available in Google. You can just Google it out and get the templates to solve. But mostly it's like finance stuff. I'll just try to give you a hands up on this thing. So it's better to use, but make sure with the operations of it. How does this work? I'll just get back. Okay. At 13% for the first year, the value is 8850. So it's 0.8850. For the next year, it's 0.7831. 0.7831. I hope you are following where I'm clicking the mouse and highlighting the things, so you also get a gist of how the numbers are arriving at. Third year, it's 0.6931. For the fourth year, it's 0.6133. 0.6133. Okay. If you can see over here, we are still far away from zero, although we reduced it drastically, but we still need to increase the discount rate further so that the amount goes to zero. The net present value comes to zero. Now let's increase it marginally. Let's say by just 1% over here. And now we'll put this amount as discount rate at 14%. Discounted cash flow at 14%. You just need to replace it with the dollar values over here. 0.8772 for the first year, 0.8772. 0.7695 for the second year, 0.7695 for the second year, 0.6750 for the third year, 0.6750 for the third year, and 0.5921 for the fourth year, 0.5921 for the third year. Okay, it's 1027. So this amount is going to be lying somewhere between 14 and 15%. Okay, so now we just try to validate it with one more calculation over here, that is at 15% over here. And if the amount turns out to be negative, then we are sure that the amount lies between 14 to 15%, and the one which is nearest to zero will be the final discount factor for us. For $1, the value at 15% goes to 0.8696. 0.8696. For second year, it goes to 0.7561. 0.7561. The third year, it goes to 0.6575. 0.6575. And lastly, for the fourth year, 0.5718. 0.5718. Oh, this amount goes to a way beyond than zero amount, right? It's minus $3,158 over here. So we can safely conclude that the internal rate of return for this project is supposed to be at 14%. Ideally, somewhere between 14 to 15%. But if we take 15%, the difference is huge. It goes to 3,000 negative. So the closest value to zero as of now, which we have, is $1,000, $1,027 precisely. So it can be said that based on the above computations, the internal rate of return for the company based on the above computations, it can be stated that the internal rate of return for this investment is approximately, always use the word approximately for IRR unless you have a precise zero net present value, 14%. Okay, I hope you got a clear clarity on this thing now, how the IRR works. The only difference you know over here is in the net present value, you determine whether the amount is more than zero or less than zero. It's positive or negative. Here you try to get as close as possible to a zero value, and that's your break-even point where you are not neither at a profit nor at a loss, and that's the IRR the company intends to have in their budgets. Okay, so that was all with regard to the second method, guys, internal rate of return. I hope you had a clear understanding of these two first methods. Now we're going to go and start with the third project evaluation technique.